Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video, I'm going to show you two things. The first thing is to talk about one of my favorite dividend paying companies. I'm going to give you all the details about the company as much as I can. I'm going to show you the valuation. And then at the end, I'm going to show you one new company that I've included in the portfolio. As you can see here, I now have 27 different companies. Before it was 26. So I'm going to show you exactly which company I've included in the portfolio. But before we get to that, as always, I would absolutely love you to click that like button, subscribe to the channel so you don't miss anything, and to join us in the Discord. You can get access to the wonderful Discord where a lot of brothers are sharing very good practices, where also you can get access to all the buys and sales, the portfolio updates, the dividend trackers, the ETF trackers, the watch lists, as well as Sharia compliant investing ebook, where you can learn basically the importance of investing in the stock market and why and what to do and what not to do and so on. All right, so let's jump into the video. So the first thing we're going to talk about is the financials of the company. Okay, and the company we're talking about today is Merck. Merck is one of the companies that I've had in the portfolio for quite some time, and as you can see right now, it's trading $118. This is basically all-time high. This is the highest this company has ever hit, basically, for ever. So today, where this price is, the highest it's ever been. So, and that's the reason I wanted to see if it's still a buy or hold or whatever. For 1 year, as you can see, is 7% up. For the last 5 years, 63%. So if you hold this company for the last 5 years, you would have at least a 63% right now, up 63%, which is quite nice. And for the last 10 years, we're 136%. I'm going to show you, I'm up quite a bit, but I'm going to show you at the end. Financials, we're going to look at the revenue and the net income. That's the two things that I would normally look for. $44 billion in 2013 to right now $59 billion. So it's nicely growing. So of course, there's some years maybe there might be a little bit decline. So 2018 to 2019, there's a bit of decline, but it bounced back in 2020. In 2020 and 2021 was even better, and 2023 looks also great once they report that final quarter. Now, in terms of the net income, it moved from 4.4 to right now 4.6. So it hasn't actually jumped a lot. As you can see here, there's a massive decline in terms of net income from $14.5 billion to right now $4.6 billion. So there might be a good explanation. There might be a reason why that has happened. It could be the fact that the company has purchased a new company. There's other things they've done, so there's reason definitely somewhere. It's not just decline of the revenue, it's something to do because the revenue has not declined in terms, and so there's some sort of expenses that happen somewhere. Okay, so that's one thing that we need to look at in the long run. Now what we need to do now, look at the Simply Safe dividend, and as you can see here, the company has 297 billion market cap, so that's one of the mega caps out there. It has a dividend yield of 2.6 right now, which is quite nice. In terms of payout ratio, okay, 93%, high for almost wait, hold on a second, this is not right. That cannot be right. So let's go back to Seeking Alpha, go to dividends, and go to here, 93% payout ratio. Wow, that's ridiculously high. So we will come back to this. I'm going to check this again. Okay, so we'll look at the payout ratios down here. So 5.5% in terms of latest increase, 8% increase in the last 5 years, and last 20 years it hasn't been great, but last 5 years has actually been growing quite nicely. And as you can see here, the dividend is actually since 2018 has actually grown basically quite high. 11 years of increase in that dividend, you get $3.08 for every share of this company that you own. Now, it could be overvalued according to the dividend method. So as you can see here, the 5-year average is actually higher than current. So the current is 2.6. The 5-year average is 2.6 to between 2.96, which is basically way higher if you think about it. In terms of PE, right now it's about 19. Healthcare, this is current PE, so the forward PE is slightly different. I'll show you that in a second. The healthcare sector is about 18 right now in terms of PE. Now moving on, earnings per share payout ratio, was 93 the last 12 months, but it's expected to come back down to less than 50%, which is quite nice, 49%. So nothing to worry about. The fact that it was 93 initially when I saw, I was like, okay, this is absolutely ridiculous. But it looks like it's coming back down again. Earnings per share is actually growing. Last 12 months is actually has declined a bit, but is going to bounce back. And there are a couple of risks with this company. I'm going to talk about it in a second. So shares outstanding, as you can see, they're buying back their own shares, which is quite nice. So they have not diluted. Actually, no, the last 12 months they are expected to dilute the shares. Okay, so that's probably they're using that money to acquire another business, which I'm going to talk about in a second. And total sales has been growing, which is quite nice. 2019 basically was the only year that they had a bit of decline, and of course every other year has actually been heading the right direction. Return on equity, we're looking about 11% right now. It has declined from 34% to right now 11%. And in terms of return on invested capital, 12% right now from a decline of 26%. Operating margins is 16%, free cash flow margin of 22%, which is absolutely huge. Net debt to EBITDA, okay, we're normally looking for below 3, and right now is just 1.01 for the next 12 months, which is very, very nice. Now, one of the main drugs this company sells is Keytruda, and Keytruda's patents is actually they're losing it by 2028. So after 2028, other companies can now basically produce that drug. Right now, Merck is the only one that's allowed. This is a cancer drug that basically they have patent on. So in 2028, that's not going to be a problem. Well, that's going to be a problem. So what the company is doing, in my opinion, is actually trying to diversify and either come up with other things. So they are acquiring. It looks like they actually bought this company already basically for $11 billion. And this article was released in April of this year. So it looks like they have actually acquired, and I'll show you the impact that this has on the business side of things, because I think they were paying for 200. Yeah, there you go. Merck has agreed to pay 200 per share for this price, which is basically 75% premium on Friday's closing. Okay, so at the time it was actually way 25 cents per higher than where it was at that point. So I like the fact that they're actually doing this, and one of the reasons they're doing is to diversify their portfolio. So if you look at it here, it says Merck has been on the hunt for acquisition over the past year as it seeks to diversify its pipeline ahead of the potential loss of exclusively on its blockbuster cancer drug Keytruda, which is basically what I was saying earlier. Key patent related to the drug, which is was generated almost to $21 billion in revenue in 2022. That's majority of their money basically are due to expire towards the end of the decade, enabling rivals to launch similar products. Now, for that reason, because of that, they're trying to diversify, which is absolutely, I love that, because there are other companies that have been in that sort of a situation, but they have not diversified. One of those is AbbVie. AbbVie is I think they lost already the patent for one of their major drugs. And in my opinion, they haven't actually acted early enough to kind of diversify that portfolio. So I like that, and this is normal for drug companies. So as you can see here, basically this company Seagen was actually bought by Pfizer not too long ago, and AbbVie did that similar sort of a thing in 2019. So these companies basically grow their revenue by acquiring other big companies, smaller pharmaceutical companies that are actually coming up and have some sort of a drug that they came up with and so on. So what I'm going to do now is we're just going to look at the earnings going forward, considering what we've just seen, okay, the fact that the company is acquiring another company. So one of the reasons it hasn't done well this last year is the fact that, because of everything else that has been happening to this company. And that for that reason, they're expecting the earnings to decline about 81%. And that's why it hasn't done well, because of that decline. But in 2024, I think they're acquiring, there was another company, in fact, let me just show you. And this is it. This is actually comes from on their own website, where they actually are acquiring this oncology company, where to help them, of course, diversify their portfolio, which is quite nice as well. So they have a few acquisitions that they're actually making right now. That's probably contributed, and the fact that they've got 511% upside from where we are now, from $1 to $8 and then $9 from there and so on. So there are quite a lot of analysts that's interested in this company as well. So I can take all of this information into basically looking forward from now on kind of thing. So it's interesting to see that. And now let's look at the ratings for this company. So as you can see here, you've got Seeking Alpha is a buy, Wall Street is a buy, Quant is a hold. Wall Street's price target, in fact, is $123 per share right now. If we go back here, you will see as well it's only 2 stars. So that means about 14% premium right now. $103 per share is basically where the price is at. In my own discounted cash flow models, as well as the discounted dividend discount model, as well as the Morningstar valuation, Seeking Alpha valuation, when you average all 4 out, you get about $131. So let's call it $132 from basically in terms of average intrinsic value. And current stock price is 118, which is the highest that we've ever seen. That's about 12% upside from where we are. But if you say, okay, I want a margin of safety of 10%, it's still a buy. If you want a 15% because of what's happening with Keytruda in 2028, then of course is about $112 per share, which is not far off, to be honest, from where we are right now. It can easily come down 5-6%, if not higher, okay, in the next couple of days or months if to come, and that kind of becomes a sell. So in my opinion right now, I would not be adding to the company, and the reason I will not be adding is this, okay. I'm up 62% right now. I've had this company in the portfolio for a while. It's actually gone up so much since then. There was one time I was buying a weekly, and then it's like what I'm doing right now with Medtronic. And then it got to a point where I think I had too much, and the portfolio was at the time a lot smaller, so it became too much for the portfolio. I think it was over 4% or whatever it was. And then I stopped buying it, and then it kind of shot from there onwards. So right now I'm up about £1,000 or 62%. So what I'm going to do is between now and the next couple of months, I'm going to keep an eye on it. If it comes back down again to maybe in the hundreds, okay, or below 100 prices, then I start nibbling again, because I really like the business model. I like what they have, and of course the 2028 is not far from here. It's another 4 years, so at least I can hold on to the business for the next 4 years, and if I got an opportunity to buy it more, I will do so, inshallah, moving forward. The final thing I want to talk about today is this company that I've included in the portfolio, ExxonMobil. Finally, I bought an oil company. I've been talking about it for a while, so I finally bought this one. It was between this one and Chevron, and based on the financials, the things that I looked at, okay, I actually decided to buy this one. I shared with the community just now the reasons why I bought it. So if you want to join us there, you can actually understand the reasons why I actually included in this company. But I think oil is not something that's gonna disappear off overnight in the next, I don't know, 10-15 years. And for that reason, it seems very cheap right now. I think it's about 18% discounted right now according to Morningstar valuation. So I'm going to start nibbling, adding a little bit more here and there, and just build a maybe, I'd say 4-5% of the portfolio, and hold on to it at least a 5-year plus, maybe in the next 10 years, inshallah, and see what happens. So yeah, that's the one thing I want to share with you guys. If you like this type of content, you like the transparency here and what we're trying to do, please like the video, subscribe to the channel. Of course, as always, let me know if you have any questions, and like I always say to you guys, I really appreciate if you guys can join us in the Discord by joining the Patreon account, where you get access to all of these things. It really helps massively the channel, inshallah. Have a wonderful day. Assalamu Alaikum.